tens of millions in the United States will see their health insurance costs soar.
The CEO of United Healthcare was shot and killed.
Millions of Americans facing a spike in healthcare premiums.
Roseanne was hit with a medical bill of $108,000 U.S.
stating that my insurance provider was declining payment.
She ended up in a Florida hospital and thought she was fully covered.
People using ride shares as a substitute for an ambulance.
Government cuts could affect Americans' health care.
Maybe you have been told that a degree was an investment. Work hard, get good grades, go to college, get a job, and pay it back. That was the deal. But somewhere between 1970 and today, that deal was turned into a trap. A $1.7 trillion trap. Built by the same institution that were supposed to give you a future. And do you know the worst part? It was not a coincidence. They knew exactly what they were doing. In the next 20 minutes, I'm going to show you the numbers they buried in the fine print, the laws that were quietly changed, and the industry that profits every single day from your debt. This isn't a story about lazy people who borrow too much. And this is a story about a system that was engineered from the very beginning to keep you paying. Let's start with comparison, because numbers without context are just numbers. In 1970, the average annual tuition at a 4-year public university was $394 per year. The minimum wage was $1.6 per hour. And that means the students working part-time, 20 hours a week during the school year, could cover roughly 2/3 of their tuition just from a part-time job. And what about today? The average annual tuition at a 4-year public university is over $10,000. Public out of state, over $25,000. And at private universities, it's around $45,000 per year. The federal minimum wage is $7.25. That same student working 20 hours a week earns $7,540 a year before taxes, which covers less than 20% of even the cheapest public university's option. And that's not inflation. Inflation would mean both numbers grew at the same rate. What actually happened is that tuition grew at 5 times the rate of inflation. 5 times between 1980 and 2020. The cost of college increased by over 1,100%. The consumer price index, basically the measure of overall inflation, increased by roughly 215% over the same period. So why is tuition so much more expensive? We will get to that because the answer will make you angry. $1.7 trillion. That number is so large, it's almost meaningless without context. So let me give you some. 1.7 trillion is larger than the entire GDP of Australia. It is larger than the GDP of Spain. It is larger than the national debt of most countries on earth. If you stacked $1.7 trillion in $100 bills, the stack would be 1,160 miles high. And that's higher than the orbit of the International Space Station. And this isn't government debt. This isn't corporate debt. It is personal debt carried by 43 million individual Americans, most of them between the ages of 18 and 35, many of them just starting their lives, many of them trying to buy a house, start a family, or simply stop living paycheck to paycheck. The average student loan balance is $37,000, but that average hides a brutal range. For many who pursue graduate school, for example like a law, medicine, or business, these numbers can go up to $100,000, $200,000, or even more. There are Americans carrying $400,000 in student debt and still paying it off in their 50s. And every single day, every day, the interest grows. Even if you make your payment, even if you're doing everything right, the math is designed so that for millions of people, the balance barely moves. This system did not happen by accident. Let me show you the timeline. In 1958, the first federal student loan program is created. The goal is to help Americans access higher education. Loans are small, interest rates are low, and the system works. In 1965, the Higher Education Act is passed. The government begins guaranteeing private student loans, meaning if a student defaults, the government pays the bank. The risk of lending disappears for banks. The incentive to lend more grows. And here's the most critical moment, the moment that changed everything. In 1976, the Congress passed a law making student loans exempt from bankruptcy discharge. Previously, if someone couldn't pay their loans, they could, like any other debt, declare bankruptcy and get a fresh start. But after 1976, that option was gone, and student loans became the only form of debt in America that cannot be erased in bankruptcy. Not even gambling debt, not even fraudulent credit card charges, but student loans, permanent. permanent. And this was not an accident. It was lobbying. The banking industry spent millions of dollars ensuring that student debt would be permanent, inescapable, and endlessly profitable. In 1978, Congress passes the Middle Income Student Assistance Act. More students can now access loans. Colleges, knowing more money is available, begin raising tuition. Why keep prices low when the government will keep lending? In 1992, borrowing limits are dramatically increased. Graduate students can now borrow almost unlimited amounts. And today, we have 1.7 trillion owed and still use the same framework, and nothing has changed. And now let's talk about interest, because this is where the trap closes. The average federal student loan interest rate is currently around 6.5 to 8%, depending on the loan type. For graduate students and plus loans, it can be over 9%. Let's look at the average borrower. $37,000 in debt at 6.5% interest on a 10-year repayment plan. Monthly payment, $419. Total paid over 10 years, $50,289. Interest paid, $13,289. You borrowed $37,000, you pay back $50,000. But here's where it gets worse. Many borrowers can't afford the standard 10-year payment. They switch to income-driven repayment, which lowers the monthly payment but extends the term to 20 or 25 years. On a 25-year plan at 6.5%, the same $37,000 loan costs you around $79,000 total. You pay back more than double what you borrowed. And if you have $100,000 in debt at 7% on a 25-year plan, you will pay back $212,000 and the bank will have made $112,000 from your education. And now remember, these loans cannot be discharged in bankruptcy. There is no exit, no matter what happens in your life. Job loss, illness, divorce, the debt remains. It can garnish your wages, it can withhold your tax refund, it can even offset your social security payments when you're retired. People are having their social security checks reduced to pay back student loans they took out 40 years ago. Now let's talk about the other side of this equation. Universities themselves. Harvard University's endowment, the fund of money it has invested, is $50 billion. And that's a 5 with 10 zeros. Harvard earns more from its endowment each year than many countries earn in tax revenue. Yale has around 42 billion, Stanford 36 billion, Princeton 35 billion, and MIT 23 billion. These institutions combined hold over $200 billion in investment assets, and they are, by any measure, among the wealthiest institutions in the history of human civilization, and they are tax exempt. Not only do they pay no taxes on those endowments, they also receive billions in federal research funding, grants, and subsidies every year from the same government that lends money to their students at 7 and 8% interest. So let me paint the full picture. A student borrows $50,000 from the federal government at 8% interest. That money goes directly to the universities as tuition. The university invests its endowment, earns 10 to 12% returns tax-free, and builds billion-dollar campuses. The student spends 25 years paying back $100,000 in interest. The government earns profit on the loans. The bank that services the loans earns fees, and the universities keep raising tuition. So let me ask you this simple question. Who is losing? I guess you already know the answer. College graduates earn $1 million more over their lifetime. You've heard this statistic. It's been repeated by guidance counselors, politicians, and university admission offices for decades. There's just one problem. It's not the entire truth. Yes, on average, college graduates earn more than non-graduates. That is true. Averages are deceiving when the distribution is widely uneven. The college premium is real, but only for certain degrees from certain institutions in certain fields. For example, a computer science degree from a state university, excellent return on investment. A business degree from a regional school depends heavily on the job market, but a liberal arts degree from a $60,000 per year private university, the math often doesn't work. A 2023 study found that 52% of college graduates are working in jobs that don't require a college degree. Not because they are failures, because the economy doesn't have enough college level jobs for the number of college graduates it produces. And here's the real picture. The $1 million premium was calculated in the 1990s, before tuition exploded. Today, after paying back a $100,000 loan at 7% interest over 25 years, that premium shrinks dramatically. For many borrowers, especially those who attended expensive private school for degrees in low-paying fields, the return on investment is negative. You paid more for the degree than the degree will ever earn you extra. And then there's the darkest corner of this system, the for-profit college industry. These are not traditional universities. They are, in many cases, businesses that disguise discover a perfect model. Take government-backed student loans, spend a fraction on education, and take the rest. Companies like ITT, Technical Institute, Corinthian College, DeVry University, and the University of Phoenix enrolled millions of students, many of them low income, many of them veterans, with promises of career placement that never materialized. They hired aggressive recruiters, paid them commissions, specifically targeted people in financial distress, veterans, single parents, people who had just been laid off, because those people were most likely to take out maximum loans. ITT Tech, for 50 years a major institution, collapsed in 2016. 35,000 students found themselves with worthless degrees and a maximum debt. Corinthian College closed in 2015. 16,000 students. The Department of Education had found evidence of falsified job placement data. They had been lying to students about employment outcomes. Between 2010 and 2020, the federal government paid out over $30 billion in student loans to for-profit institutions. Much of that money went directly to executives and shareholders. Some of these schools had profit margins of 30 to 40% on federal loan money borrowed by people who will spend decades paying it back. When these schools collapsed, the loans didn't collapse with them. The students still owed every penny. Between you and your loan, there's a company, a loan servicer, and this industry deserves its own chapter. Navient, Salime, Mohela, Great Lakes, these are the companies that manage your student loan account. They send you bills, take your payments, and communicate with the government on your behalf. They also have a financial incentive to keep you in debt as long as possible. In 2017, the Consumer Financial Protection Bureau sued Navient, then the largest student loan servicer in America, managing $300 billion in loans, for systematically steering borrowers into forbearance instead of income-driven repayment plans. You may be asking, why does that matter? Forbearance means you pause payment, but interest keeps accumulating. Income-driven repayment means you pay less, but you make a progress. Navient made more money if borrowers accumulated more interest, so their employees on phone calls with struggling borrowers pushed forbearance hundreds of thousands times. In 2022, Navient settled with 39 states for $1.85 billion. The settlement found that Navient had engaged in deceptive practices for years, affecting millions of borrowers. But here's the thing, the settlement didn't give the money back to borrowers as cash. No, it cancelled about $1.7 billion in private loans for a specific subset of borrowers. Most people affected by Navient practices received nothing. The system rewarded the people who manipulated it, and it punished the people who trusted it. And this crisis does not hit everyone equally, and the data on that is stark. Black borrowers graduate with an average of $25,000 more in student loan debt than white borrowers with equivalent education levels. 4 years after graduation, the average black borrower owes more than they originally borrowed because their income are statistically lower and their interest accumulates faster than they can pay it down. 12 years after graduation, nearly half of black borrowers are in default or delinquency compared to 17% of white borrowers. This is not about personal financial decision. Black students are more likely to attend lower resourced institutions, less likely to receive family financial support, more likely to need to work during school, and more likely to end up in predatory for-profit schools, which specifically recruited in communities of color. The student loan system does not create racial inequality, it amplifies it. Students who already start at a disadvantage are systematically pushed toward higher debt, worse institution, and less favorable outcomes. A system that claims to be a great equalizer, a ladder to the middle class, has for many become the floor that keeps them from rising. Student debt has become one of the most politically charged issues in America, and that makes it almost impossible to have an honest conversation about. In 2022, President Biden announced a plan to cancel up to $10,000 in student debt for most borrowers and $20,000 for Pell Grant recipients. For millions of people, this was transformative. For others, those with $100,000 or $200,000 in debt, it was a drop in the ocean. In June 2023, the Supreme Court struck it down in a 6-3 decision. The court ruled that the administration had exceeded its authority. The justice who voted to strike it down had collectively benefited from significantly subsidized educations at elite institutions. 3 of the 6 attended Yale Law School, one of the most expensive law schools in the country, during an era when tuition was a fraction of what it is today. I'm not here to tell you what the right policy is, but I will tell you this: the people making decisions about student debt have almost universally never experienced it themselves. They graduated in an era when tuition was affordable. They have no frame of reference for what $200,000 in debt at 25 years old actually feels like. Meanwhile, the lobbying continues. The loan servicing industry has spent hundreds of millions of dollars lobbying against any form of debt relief, because debt relief means less money for them. Every dollar of debt that gets cancelled is a dollar they no longer longer earn interest on. Now let me show you something, because the United States is not the only country in the world with universities. Germany, tuition at public universities, 0, free for everyone, including international students in many cases. Norway, free. Sweden, free for EU students. Finland, free. Denmark, free, and students receive a monthly stipend of roughly $900 to cover living expenses. France, annual fees around $200 at public universities, not $20,000, $200. The United Kingdom charges tuition about $30,000 per year, but loans are income contingent, capped at 9% of income above a threshold and forgiving after 30 years regardless of remaining balance. Australia has a similar income contingent system. If you don't earn above a threshold, you don't pay, and the debt is indexed to inflation, not to compound interest designed to grow it. Every other major developed democracy has concluded that education is too important both for individuals and for society to be funded primarily through debt that follows citizens for decades. The United States is the exception, not because it can't afford to do better. It spends more per student on higher education than almost any other country. The money is there, it's just flowing in a different direction. The numbers are one thing, but let me tell you what student debt actually does to people's lives. The Federal Reserve has found that each additional $1,000 in student debt reduces the likelihood of home ownership by 1 to 2 percentage points. With the average borrower carrying $37,000 in debt, that's a 37 to 74 percentage point reduction in home ownership likelihood. This is one of the primary drivers of the housing crisis. Studies show that student debt delays marriage by an average of 7 years for borrowers with high balances. It delays having children, it delays retirement saving because money going to loan payments is money not going into 401k or IRA. One study found that if millennials with student debt had instead invested those payments into a retirement account starting at age 22, they would have on average additional $600,000 in retirement savings by age 67. $600,000, that's the hidden cost of student debt that never appears on any loan statement. And there's a mental health dimension to this that is only beginning to be understood. A 2022 American Psychological Association study found that 77% of student loan borrowers reported significant negative psychological impacts from their debt, including anxiety, depression, and a persistent feeling of being trapped. Not just financially trapped, existentially trapped as well. Alright, we've been in the dark for a while. Let me give you some light. First, if you're already in debt, there are options you may not know about. Income-driven repayment plans, IDR. Cap your monthly payments at 5 to 10% of your discretionary income. Second, if you work in public service, government, non-profit, public service loan forgiveness can eliminate your remaining balance after 10 years of qualifying payments, 120 payments, that's it. If you work in education, healthcare or non-profit, look into this immediately. It is real, it works, and most people who qualify don't know about it. Third, refinancing. Private refinancing can lower your interest rate if you have good credit and stable income, but it converts federal loans to private, which means you lose access to IDR and forgiveness programs. Do the math carefully before you do this. Fourth, if you're still in school, considering college, run the numbers before you sign anything. Research average salaries for your intended career. Calculate what your monthly payment will be. If the payment is more than 10% of your expected take-home income, reconsider the school, the program, or the loan amount. Community college or 2 years followed by transfer to a 4-year school can cut your total cost by 40 to 60% with the same degree at the end. Trade school and apprenticeship are producing workers who in many cases out-earn college graduates without the debt. Electricians, plumbers, HVAC technicians, these are not consolation prices. These are skilled professions with genuine demand and genuine compensation. And the last one, know your rights. If a loan servicer has misled you, you can file a complaint with the Consumer Financial Protection Bureau. If you attended school, defrauded you, you can apply for borrowed defense to repayment, which can discharge your loans entirely. The system was not built for you, but there are exits if you know where to look. So why doesn't this change? Why does the system remain essentially intact when 43 million people are drowning in debt? Because the people who benefit from it have more power than the people who are harmed by it. Universities benefit from the current system. Tuition revenue funds their endowments, their buildings, their administrative salaries. College presidents at major universities earn between $500,000 and $5 million per year, and there are over 100 university administrators who earn more than the president of the United States.
They loved me. They called me daddy, right, last time?
Banks and loan servicers benefit. They earn billions in interest and fees, guaranteed by the federal government, on debt that can never be discharged. And the political class, many of them benefit too. They attended universities when it was affordable. They have been funded by the financial industry and they face no personal cost from inaction. The people who are harmed, 43 million borrowers, are largely young, often politically disengaged and divided. Some want forgiveness, some think forgiveness is unfair to those who already paid. Some are Republicans who distrust government intervention. Some are Democrats who think the proposals don't go far enough, and because they are dividend, they are easy to ignore. This is how systems of exploitation survive. Not by force, by complexity. By making people argue with each other instead of at the people in charge. The student loan trap is not a natural disaster. It was not inevitable. It was built, piece by piece, law by law, lobby check by people who stood to profit from it. And it could be unbuilt, not easily, not quickly, but systems that were made by people can be changed by people, when enough of them understand exactly what was done and exactly who did it. And that starts here. That starts with this conversation. Share this video with someone who's paying back loan. Share it with someone who's about to sign for them. Share it with someone who thinks borrowers just made bad choices. Because the choice that was made by Congress in 1976, by lobbyists in the 1990s, and by university boards in the 2000s. Not by 18-year-olds who were told that education was the only path forward. Subscribe if you want more of this. See you soon.